Welcome back to All Things Money. I'm David Blain, and today we're giving an update on the equity markets. We started in the first segment. So we were talking about the what is different between this decline in early 2010 and the Waterfall collapse in 2008. Another thing that's different, in 2008 we were in the midst of the worst global recession since the 1930s. Today, things may not be perfect. We still have a lot of unemployment. We still have a lot of problems. But the fact of the matter is we've largely pulled ourselves out of this global recession to a more favorable economic climate. The next thing, in 2008, we were in a tremendous earnings recession. Once again, along with a global recession, it's hard for companies not to have their earnings go down. And so in 2008, we were largely in an earnings recession as well. Well, in 2010, the earnings so far have been very good. The majority of companies are registering positive earnings growth, and so there are a lot of differences. Another thing, the credit markets in 2008, the credit spreads between treasuries and other instruments were widening. We saw a lot of dislocation in the banking sector, financial sector. Here in 2010, we don't see those things. We see the banking system largely stabilized. We see a lot of positive signs that some of that has been moderated. So the bottom line is that we don't think that the current decline is going to turn into a major bear market such as we had in 2008. Once again, we don't know. We don't like to make predictions, but when positioning our portfolios, we like to have a general idea of what's going on in the market, and we certainly don't attempt to time the short-term movements of the market, but it's a good idea to have a general overall idea of where you are. A couple of things that we're looking for, once again back to the concept of market breadth. We're looking for advancing volume to outpace declining volume, and that will signal that we're moving out of this cyclical bear market and back possibly into a bull market. The other thing we look at is sentiment, that this decline in the markets has brought the sentiment level, meaning the optimism or pessimism of both individual retail investors as well as professionals, had reached a very significant peak back in April. A lot of that optimism has since been taken away with the decline, and that's good. That we want to be investing and buying at points of pessimism, not at the peaks of market. So that's a couple of things that we're looking for. We also think that there's several things that are continuing in the world that we're going to address. The first is the European sovereign debt crisis. We think is somewhat of an overreaction to what's going on, that the fundamental data behind the whole European Union is still somewhat positive, that it could turn into something worse, but at least right now the crisis in Greece and Spain is not completely destroying the Eurozone. And in fact, on global growth, when you look across the world, the European crisis has had a minimal impact. We talk about China, it may even be a little bit of a positive for China. And so we see, as we mentioned already, that the uptrends are still intact across the world, that this appears to be a correction within a cyclical bull market. We would take this opportunity. We think that the markets have become a little bit oversold, and it may be a good time to actually add to one's position. As we talked about before, the European Union has gone down significantly more than other markets, and so for the venturesome, it may be a good opportunity to add some European exposure. China, the past year or so, has really taken a backseat to the U.S. and some of the other markets in terms of percentage appreciation. There was some concerns about the growth of China and the trends continuing forward. Well, they've taken several steps, namely they now have a more restrictive monetary policy to curb lending in the property market. They've added a new sales tax and property taxes, and euro weakness has resulted in threatening Chinese exports to the Eurozone. Well, some of these moves that China has made seem to be working out, and the economy is still growing at a healthy pace, but they seem to have slowed it down a little bit enough to keep it under control. And actually, the euro's weakness has given them a window of opportunity to manage the Chinese currency versus the dollar and ease some of the pressure on China to immediately reevaluate their currency. So we think that the China theme, although it's kind of taken a slowdown recently, we think that the China growth story will resume its upward trend in the near future. Once again, back to Europe. We think that the news regarding Europe is largely overdone. The relative strength of the European markets has actually improved, and for all the problems that have been going on, the euro has actually appears to have stabilized. Now, none of our euro models right now are saying that you should actually buy the euro. Only the venturesome would do that at this point. We tend to be a little bit more conservative, and so we would not necessarily go out and buy the euro, but it seems to have stabilized enough to possibly avert a disaster. So what we're looking for in the recovery from this bear market is long-term uptrends continuing. We're looking for European markets to continue to recover, as well as we're looking for the Chinese stock market to resume its leadership position in the world. Well, that takes us to our next break. When we come back, we'll take a look at some of our viewers and listeners' email. For All Things Money, this is David Blain.